Good evening. Thank you all for joining us with our house hunting and hacking presentation, where we're unlocking the power of real estate together. We meet on the second and fourth Tuesdays of each month, 7 p.m. Mountain Time. Today we've got with us Genevieve Henderson, who is our loan advisor, John Nichols, who is our realtor, and myself, Amber Zamudio, an insurance specialist. We're really excited to have you with us this evening as we talk about the detrimental impact of guideline changes on the condo and townhouse market. This is a really interesting topic, great thing to talk about, and I will turn it over to Jen.
Hi, thanks, Amber. And I'm going to toggle here for a second over to my topic presentation. So please bear with me a second. Ooh, there we go. All right. Sorry, my computer seems to be running slow tonight, I guess with the Zoom simultaneously. I'm having troubles with my mouse.
You got to get a cat, Jen.
Yeah, I think I'm gonna have to maybe do like a cleanup on my laptop to get it to run maybe a little smoother. Let's see, I'm not sure. Are you able to see right now the topic slides?
Yes.
Okay. I wasn't sure if it carried over from the other PowerPoint.
It is showing your topics, but it's not showing it full screen. There we go.
Are we good?
Good.
All right. Now I'm gonna also go ahead and I'm gonna also close another application here to make sure maybe it'll improve. Okay. Here we go. All right, so we have the detrimental impact of guideline changes on the condo, townhome market. There we go. So who needs this information? Realtors, lenders, condo homeowners, and that would also include townhouse. So anytime I'm saying condo here, I'm almost synonymous pretty much with townhomes. Condo and townhome shoppers and investors. Why is this information important? Because it affects the values of condos. It causes the lending issues for purchases and refinances. So if you're in that mindset we've been touting now for 2 years of date the rate, buy the house, this could affect you. This could affect your ability to refi and get that lower rate that you're anticipating. Also creates opportunities for realtors and buyers. So there is some hope in this presentation tonight. Sorry, I got this bar in my way. What is the industry standard adjustments that we're talking about here that's creating this topic? So we have here, I think I've got it a little bit too big. We have these deductible, these requirements here are for insurance policies for the HOA on condos and townhomes. And these are outlining the requirements. And then over here on the right-hand side, it's these things, but I've also blown them up bigger so that we can review them. So the first one is the maximum allowable deductible for all required property insurance perils is, and sorry, it's getting cut off on my screen, but it's basically a 5% maximum is what's allowed on these deductibles. Like if you think about your wind and hail deductible, your roofing deductible that you have typically on your insurance, they came and put that on here, starting in May of 2023 was when this went into effect. Here,
So just to clarify, Jen, it's meaning that if they charge the homeowner more than 5%, it won't pass to get a loan. They don't want the burden of the homeowner to be more than 5% of what it would cost to replace these things. Is that how I understand it? Because I'm still a little unclear about the whole 5% and what that means.
you could look at it as being the homeowner, but it's really the policy of the HOA. So it's that the HOA cannot be liable for more than 5% if per occurrence.
And so the theory behind that is because if it's more than that, it's just going to deplete all their reserves. But then the trade-off is that obviously the policy is more expensive, so the homeowner association fees will probably go up.
Yeah, that would definitely be a ramification of this change. And like this snippet also that was included on the left-hand side, but now it's blown up a little bit bigger. It's pointing out that if you don't have at least the 5%, if it's greater than a 5% coverage amount, you do have the ability to find if this policy that's in place for the master insurance policy for an HOA is per occurrence or per unit, because there is this exception here to get around the 5% maximum deductible, and that's if the policy is a per unit policy. But as in speaking to insurance agents about this that write commercially, as well as going back and reviewing many of my past clients that have closed in condos, the master insurance policy having a per unit type of policy to qualify for this exception, I was unable to find that. I don't believe I think it would be incredibly rare, especially too, again, after consulting with insurance commercial agents.
Yeah, I've never seen a commercial habitational policy that had a per unit condition. I've never seen that.
See, and we have our insurance expert here to confirm.
Given I don't do that much with the commercial side, I have had a few clients who have had a habitational policy, which would be like a master condo policy, and I've never heard that as an option. So.
Wow. Gotcha. And then also we have this little note that's down here, but I blew it up so people could actually read it. It's talking about like another exception here, in that a deductible buyback insurance policy purchased by the HOA or co-op, this can end up covering the fact that their deductible would exceed the guideline allowance. So we're going to also mention that again later. This is also going to pertain. So typically, if you have a condo that is a 1 to 4 unit property, they aren't generally required to go through the same motions in proving condo documentation like a typical condo would. However, this new insurance requirement would also apply to a 1 to 4 unit property, and also would apply to townhomes. So it's going to impact all of those. And the problem is that we have insurance companies that are pulling out from entirely from insuring HOAs in condo or townhome situations, or they're increasing those deductibles beyond what the guidelines allow. So when did this adjustment go into effect? Again, it was May 1st of 2023. That's when they were required to be implemented. It was announced in December of 2022. But obviously the implementation is what really creates this problem. Why is this suddenly a big issue? Because the insurance carriers are reducing coverages and increasing deductibles across the board. And that equals condos are unknowingly becoming non-warrantable.
Mm.
And that is a very negative, bad thing that most people don't know what that means in our industry, but that means that a typical FHA loan, a conventional loan, will not be able, even a VA loan would not be able to be lent on that, in that whole project that is affected by that policy. So for buyer agents, I would say, I want to warn you that condo buyers or townhome buyers of the risks, I want to warn you of those risks and that they may want to purchase a detached home instead. So I would say for buyer agents, you could warn your buyers that this is a risk that they're taking in purchasing a condo. If they're on, flipping out through the edge and they can actually afford a detached home, I would highly suggest they flip to the detached home if they can afford it, if they can qualify. I would also ask the listing agent for a copy of the HOA master policy as soon as possible. If you can even get that before you go under contract, you save yourself some time from even having to write the contract, if you can already weed out that that's an issue. Or at least I would say during that initial week of doing inspections, earnest money, looking at those disclosures, obtain a copy, have your lender obtain a copy of that. Work with a lender that understands the condo buyer and their funds need to be protected. So review the policy as soon as possible. So most lenders don't even know about this right now because it's so new and it's starting to pop up right now. But sometimes it's not being found out until right before you go to get it clear to close. So if you want to save yourself and your buyer and protect them, you need a lender that understands that this is a possibility of wasting and throwing away money and time. So for listing agents, I'd say obtain and review the HOA master policy to find out if the condo is non-warrantable for deductible reasons. Because again, from the other side of this, you've got a listing agent who has no idea that up until now, everything has been fine and dandy, but because this policy has changed and maybe the renewal of that insurance policy has changed the terms, it could be non-warrantable. And as a listing agent that we just encountered last month, they ended up, working with us for a month and a half trying to close that deal, only to find out that it was not doable. It had become non-warrantable. So if you can know your stuff as a listing agent and find this out early, you could save your buyer a lot of time. You could save your seller a lot of time in also protecting them and maybe what they might be contingent on, by trying to find out this information beforehand. If the condo project is currently FHA approved, there's a loophole there to successfully close with an FHA loan until the approval expires. So again, as a listing agent, if you know this, you know that time is of the essence here, because once that FHA approval goes away, they won't be able to they won't be able to lend with an FHA loan either. But that would be the only one, because the conventional doesn't have that insurance that FHA does when it puts it on its approved list. And that's why there's a loophole with FHA. Conventional doesn't have that. So it could be non-warrantable technically still for FHA today, but because it has that approval, that means that they're going to insure loans that are closed still in that condo project as long as that approval is still in place. So, sorry, gotta keep toggling here. My bar keeps getting in the way. For condo homeowners, obtain and review your HOA master policy. Continue to be involved in your HOA to make sure the deductible coverage doesn't exceed 5%. Go to those HOA board meetings. Ask to see and review this before it goes into effect. Understand that if the policy renders your condo non-warrantable, you won't be able to refinance to a better rate, obtain a cash out refinance. You know, if you need to do a special assessment, or, you know, you just want to fix it up, or you need it for anything else as a debt consolidation, you won't have that option. Or you won't be able to sell to anyone other than a cash buyer. And John can speak to that. John, what do you typically see as far as a cash buyer? How much of a deduction do they generally get to have compared to the typical market value?
It depends a lot on, you know, how long the home has been on the market, but I mean, I've seen people on a $750,000 home come in at 700,000, and, you know, people, the sellers are thinking, you know, we can close quickly. This is cash, no appraisal, none of these risks, condo desk, all this stuff, if it's an attached dwelling. And so I couldn't give you a percentage. I think it is a case by case basis, but I think that you can get a pretty good discount. It's definitely not chump change. It's not like we're giving you 2,000 to 3,000, but it can be a lot more than that. I had a quick question. So Amber, let's assume that you're in a condo and you're starting to get active with the HOA, like I might have to do with a couple of mine, and then I find out that they just they just signed a renewal of the master policy, and unbeknownst to everyone, in order to save money, it's a 10% deductible. Is there a way midstream to, you know, change that? If the HOA has the money, can you alter the policy to go down to the 5% in order to, you know, save everyone's bacon when it comes to maybe wanting to refinance, sell, etc.?
Yeah, you know, we're in a really tricky market, especially in Colorado with insurance carriers and the guidelines that they're putting into place. A lot of times they will have a minimum of whatever the deductible is, and that's non-negotiable. They will not lower it. You can increase it, of course, they don't care about that. But the reason why they're doing it in a lot of cases is because it's less payout on their part. So in most cases, what you would have to do in that is reshop the policy altogether. You know, you traditionally get your renewal documents 45 days prior to a renewal, shop it at that time. Your HOA should be working with an insurance broker to shop those insurance policies, because not every brokerage or every, you know, captive agent is offering the same thing. I see a lot of habitational policies with farmers, for instance. And while 10 years ago, they may have had awesome habitational policies, that may not be the case right now. When you're with a captive carrier who only has one policy to shop, that's all you get. When you get a renewal that says your deductible is going to 10%, you take it or you don't. So to work with a broker is the first step, a commercial broker in this case, and have that policy shopped. Absolutely. But you do need to express your interest in having that done. Traditionally, a broker in the commercial side won't just shop every policy at renewal. So you need to ask. Absolutely.
Okay.
Oh. And then consider whether you should sell and buy a detached home whose value isn't hinging on a condo HOA master policy, and whose neighbors might eventually be primarily renters. Because people who come in and buy with cash are generally investors, and they're going to put renters into those units next to you. And that can sometimes end up, you know, turning a neighborhood or community and not be the place that you thought you bought. And since we're currently on this slide here talking about what we want to tell condo homeowners, I was gonna ask, I thought Amber had some really good information that she could share with regard to the type of coverages that can help when it comes to these things that are deductibles, which are typically going to create special assessments.
Absolutely. Thanks, Jen. There are two kinds of assessments that your HOA can assess. One of them is a loss assessment and one of them is a special assessment. While all loss assessments are special assessments, not all special assessments are loss assessments. Your traditional HO6 condo insurance policy will cover loss assessment coverage up to a certain limit. Now, traditionally, the base of that is $1,000. And hopefully you're working with an agent who is advising you to increase that coverage, because these days you have to. It's not really an optional thing. I mean, if you want to take the chance, I guess you can, but for like $75 to $150 more for a year, the difference between $1,000 and $25,000 in loss assessment coverage is going to save you possibly $25,000, $24,000, if you will. Loss assessment is coverage that comes into place when a condo has a huge deductible. What they'll oftentimes do is say, we have 250 units. Our deductible is X. We're going to charge, we have in the HOA reserve this much money for the deductible, but we're going to charge every one of these unit owners a certain amount in order to make up the difference for that deductible. And right now you're seeing a lot of that because there have been so many hail claims, there have been so many wind claims, lots of claims come up when you're in a condo unit traditionally, because you're sharing a lot of the same pipes, you're sharing a lot of the same walls. Not everybody takes care of their property the same way. But that being said, if they were to assign you a loss assessment and you had that coverage on your policy, you can, submit a claim to your insurance carrier and that will help you out. Now, back in 2017, we had that huge hailstorm, and I always refer to 2017, but it's been like every year after that as well. I guess I refer to the 2017 because that impacted me personally. Anyways, back in 2017, there were several condo units in Wheat Ridge, Colorado, that had sustained major hail damage. And there were a lot of people who were charged a loss assessment to make up that deductible, and their insurance did not have a large amount for loss assessment coverage. They had to then pay that out of pocket. Well, those people couldn't afford $10,000 out of pocket. They're barely making their rent, their mortgage payment. So they had to either take a second out, and in a lot of places, those people ended up in foreclosure, unfortunately. When I had said earlier that all assessments are special assessments, but loss assessments are not, loss assessment is a special assessment. Not all special assessments are covered. If you have an HOA who decides, oh, we need to, redo all the flooring and paint everything, and we're giving our building a makeover, that is not related to a loss. That would not be covered on your insurance, your condo HO6 policy. What they would then do is assign everyone a special assessment, and you're pretty much paying for that out of pocket. So there are some things that you should be aware of when you're getting into a condo policy, or getting into a condo period. Always go for a higher level of loss assessment coverage, but know that if there is a special assessment that's related to maintenance or the appearance of the dwelling or something like that, that is not going to be covered under your loss assessment coverage through your HO6 policy.
Wow. Scary stuff, Amber.
It actually is very scary. And Jen, when you're saying like they're increasing these deductibles, all of these condo owners are paying for it. You're not any longer paying for, a $600 condo payment and then a $250 HOA payment. You're paying your $600 condo payment, and now you're paying a $600 condo HOA payment, because they can raise those things with the policies. And we're seeing a lot of that actually right now. It's very, very scary for condo owners. One nice thing is when you're in a townhouse, you're insuring the entire structure. So they're not, necessarily putting the same HOA type thing on you. However, if there's like, community buildings or things like that, it's a little different. You still want to carry loss assessment coverage on your HOA or on your homeowners policy for community structures, things like that. But it's not the same, because in a condo, you're insuring the interior of the unit itself, the studs in. You're not insuring the roof, the siding, all of those things. Whereas in a townhouse, you're insuring everything because you own the exterior of the structure, you own the piece of land that it's sitting on and things like that. And that's why it's a little different. Townhomes are more so insured like single family dwellings.
Wow. And so for condo shoppers, you need to understand the risks of during the purchase transaction. You need to have a very good buyer's agent. There's been a lot of upheaval about that, in recent weeks with some legal decisions. But you need a buyer's agent. Their commission alone or whatever their fees might be could save you from getting into a situation with their knowledge and their research and understanding the type of assessments that could be rendered on that unit. You need someone who's able to review that with you, that knows to look for that. You need an experienced realtor to represent you. Understand the risks of the policy deductible changing after you've purchased a condo. So even though it's fine now, understand that could become a problem later. And
So
then
do you
consider,
think, sorry to interrupt, but do you think a lot of HOA boards even understand this when they're making these decisions?
I don't think they understand that it's going to render them unlendable or non.
And these are the very people that might want to keep it nice and be on the board, and then they plan to sell it and they want to sell something that's nice and control that. That's interesting. They may not even know that in the name of saving money in the short run, they're hurting everyone.
Right. I mean, even if they think, oh, okay, we're willing to take the risk and do a 10% deductible, and we'll just increase our reserves,
Mhm.
Nope. You're gonna have a really big problem on your hands with people not being able to sell their condos. It's gonna affect their market value. And then consider whether you should buy a detached home whose value isn't hinging on a condo HOA master policy.
Wow. Once the word gets out about that, that's just even more people chasing the lower level. I say that respectfully, but the entry point single family homes, which are the ones that appreciate the most and have the most demand. And that will definitely drive up the price on those.
Yeah. So also consider that if you choose to do the detached home, if you can afford it, if you can get approved for that, it's going to probably have an accelerated appreciation given what's going to be happening in the condo and townhome market. Great point, John.
Do you think it's one of those things that'll just take time? I mean, it doesn't seem like you're hearing a lot of education out there in the public. So will it just be that as more and more people get burned and then maybe it makes it to the news, then we'll see a rush of people understanding this? Or how do you see it unfolding?
Possibly. I mean, I just recently, I went under contract on another condo. It's closing on Friday, and the HOA project manager that I spoke to, I was expressing why I suddenly wanted a master policy to review, for a condo that we had, just gone under contract with, and typically we would get that document later in the process. But I was asking for it immediately to try to make sure that I could try to protect the client and their, initial costs like inspection and such. And so we started chatting and I was explaining the reason for my hurry and trying to review that document. And he mentioned that he had a attorney, a friend of his, who recently was on the news. He actually had sent me the video of that news report coverage that was talking about, it didn't go quite into depth with regard to lending and underwriting guidelines, the impact of that, but it was definitely going over the changes in the insurance industry and how that was impacting and really hurting condo and townhome owners. with the increase in their HOA fees. And how people were saying, I just can't afford this anymore. I need to sell this. And again, you hope that the master insurance policy is sufficient right now for them to be able to sell that.
Hmm.
But here's
I
kind of,
wonder how many, like, a lot of these HOAs are not professionally managed. I assume the professional managers have a better feel for this and are really pushing for the 5%. I guess we all have a lot of asking to do.
yeah, I mean, I would really hope that they have that kind of knowledge. But as we saw in our recent transaction, they had no clue and didn't understand why we were suddenly the first lender they'd heard about having this issue. And it's because of a recent change in the guidelines. So they hadn't encountered it. They didn't realize it was a problem. And as I was trying to express to them, this could open them up to a lawsuit in the sense that I think condo owners are relying on those HOAs to make decisions that protect their values on their homes. And if they were to, sign on with an insurance policy that created that caused their condo to suddenly become non-warrantable, they have damages for that. They're going to be looking at cash buyers. And as you just pointed out, that could be a giant chunk off of the selling price.
Mm-hmm.
Alternatively, you go in, you lower the deductible and keep it to what the HOA can, do for these potential sellers or buyers or what have you. And it makes the condos unaffordable for the actual people who are already in there. So it's a catch-22 on this.
Yes. Yes. It's, I mean, don't get me wrong, as a single family homeowner, and you guys both are, we're both feeling the crunch, with our own insurance policies from our side of things, but I can't imagine also possibly hurting my values and it being beyond my control, in being in the hands of an HOA.
Absolutely.
So if I'm a listing agent and I'm about ready to sell a condo, like I might be for that one I mentioned earlier, that's one of the first things I need to do, I assume, is to find out about that deductible. It seems like that is like the linchpin, because technically, if it is more than 5%, we really can't offer any kind of loans. You have to call it a cash offer or a cash purchase only.
You could do the FHA loophole if it's FHA approved
But that's only going to last for how long?
until typically an FHA approval is a 3-year approval. So depending on where they're at in that time.
So in the old days, let's assume, like, when we go back to the Darrell Road things that you helped me to buy, assuming that the deductible was 5%, even though it's non-warrantable based on the investor to primary owner ratio, are you saying that those kind of condos will no longer be able to get a conventional loan?
If the deductible is over 5%.
But if everything's good with the deductible, then it still is possible to get a conventional loan on a non-warrantable.
Yes, so the loophole that I've used with you, that would still,
Okay.
it's my understanding that is still in existence, yes.
So a lot is riding on it doesn't seem like such a big deal, but it really is, like, what this deductible is.
Yeah, and again,
So
that
if I'm,
that loophole that you and I have, that I've used for our clients and stuff, that's, specifically for investors, because there's a higher threshold, on the HOA, statistics in projects for investors than there would be if you were a primary person
so
purchasing.
it'd be easier to get a conventional loan if it was a primary resident, assuming that the deductible is 5% or lower. But even for a primary resident, if that deductible is too high, then you pretty much throw out the possibility of doing a conventional.
Yeah.
Wow.
Mhm.
This is a big deal.
Yes, and I see this meeting and this topic as cutting edge.
Yeah, I mean, the masses are gonna be really appreciative.
Yeah, we'll be on the news, I'm sure. So here's the little spark. This is the little silver lining part. So investors, pay attention. For investors, if you're using a conventional loan, understand the risks for buying and refinancing and selling, because again, if anything changes in this condo project or townhome project, it could affect your investment. Non-QM loans are an option. A lot of them will do non-warrantables, and they're starting to change their guidelines for non-qualified mortgages to address this issue that has been created recently about the deductibles. But non-QM loans are not ideal nor as profitable. So if
They're higher interest rate, right?
exactly, yeah.
And this is your, sorry, this is your DSCRs?
DSCR is one type of non-QM, yeah. There's other ones that are for bank statement loans or for just for non-warrantable condos. Could make it a non-QM loan. And you're generally going to be paying 1-2% higher on your interest rate for that. And for investors, that's going to affect your rate of return.
Definitely.
And then if you're using cash, realize that there's going to be a massive amount of condos becoming available only for buyers like you. So if you like to pay cash, you could have a lot of opportunities coming your way. And so you need to have a buyer's agent who knows how to go and look for these and understand that sometimes maybe the listing agent doesn't even know about this yet. And the buyer's agent can go and do his research, look at that master policy and see if that linchpin is there. And then he can educate the listing agent, hey, by the way, did you know that this is a non-warrantable? And I've got an investor here who's willing to pay cash right now. So you really, it's so important. So important to have a lender that understands that this is a big issue and you could get down to your closing, waiting for that clear to close and not be able to close. Your earnest money may have already gone hard, so you may have lost that. You need a buyer's agent who understands the importance of trying to find this ahead of time and how it can actually be used in negotiating. You need a listing agent who understands to look for this if they're going to be listing your condo or your townhome so that they can check this and save you from a month and a half of waiting for something to close that was never going to close from the beginning.
And we actually had that. Jen and I and Amber all were involved in one that had exactly that.
Yep.
So as a listing agent, if I run across that situation, I pretty much need to tell them, you know what, unless you want only cash buyers who are going to give you less, we're going to need to wait it out. And you need to get involved with your HOA to get this thing changed, because in the long run, the extra time it takes to do that could be very worth it compared to taking a significantly lower cash offer.
Yes.
Mm.
Or maybe expressing the urgency with people who are thinking about selling and helping them understand that insurance companies are dropping policies and renewing for unfavorable policies that are going to impact your value. And if you don't have that problem right now, it might be a really good time to consider selling it now, as opposed to waiting, given like the perfect storm that's accumulating here.
So Amber, if we run into a situation like that, and then I convince the board and they all realize, wow, the scales have fallen from my eyes and we need to do something.
Mhm.
We couldn't probably get the current policy and that company to change it. We would just have to say, we want to non-renew and we're going to shop around. Right. And then we have to find one that will do the 5%.
Yeah, in most cases. I mean, you could potentially get an insurance carrier to have a lower deductible, but the reason why they're increasing the deductible is because the HOAs can't afford it. You know, the HOA can't afford the 5% deductible. They have to go to a 10% in order just to maintain their ability to pay the insurance. You know, that's like a lot of what homeowners are facing right now, even because a lot of insurance carriers now currently have gone to a 1% or $5,000 wind hail deductible, have gone to, you know, a rate increase that's so high that people have to take a higher deductible just to offset the cost. Especially when you think about people who are, you know, in set financial situations where they don't have flexibility of income or can't go get another job or things like that. Think about the elderly, people who are, you know, disabled, things like that. They're on a limited budget. When these prices increase, they have really no choice other than to increase the deductible, lower coverage, all of those things, which are very scary because who wants to lower coverage, especially related to wind and hail, or increase the deductible, especially related to wind and hail, when every year we're losing billions of dollars because of wind and hail.
Wow. So you have the unperfect storm.
Mhm.
You got insurance companies that want higher deductibles. You have the HOA boards and the HOA members and residents that want their deductible low, and they figure, oh, what the heck, let's just go, or excuse me, they want their premium low, their monthly HOA fee low, and they figure, oh, I'll worry about it later. Yeah, whatever, just do the higher deductible. But by doing that, they're increasing the chances that they won't be able to get a good price for their home.
Mhm.
Mm.
Mhm.
And, you know, some of them, it is a situation where they can't, the carriers will not. In the news report that I had listened to, it was stating how Travelers is no longer writing condo HOA policies anymore. And so the one where we had, it had been enacted actually in May of 2023. And it had the 10% wind hail deductible. When I spoke to that insurance commercial agent, she was saying she shopped it everywhere. And this was all that she could get was now granted, it was an older condo. But this was all she could find was a 10% deductible.
Mhm.
So
Yeah. And one thing to keep in mind is there are a lot of things that determine what kind of deductible a carrier will offer you. You know, if you have a roof that's, you know, think about Travelers insurance right now. So I have been using Travelers as, you know, a major carrier saver for all of these policies that are having huge increases. Last week, Travelers reached out to my agency and said, you can write one homeowner's policy a month. That is devastating for me. like yeah, it's crazy. And I'm not the only, you know, insurance agent who's going through that. All of Colorado has had a quota now with Travelers they cannot exceed. When you have a home that's over 10 years of age for the roof, so a 2015 roof, for 13 roof, you're not getting insurance with Travelers. You'd be lucky to get insurance with anybody at that point. Even if you can get an actual cash value replacement cost on a roof, it doesn't necessarily matter because some carriers will not extend a policy with a roof over 10 years of age. And the reason for that is because they know, obviously, hail is coming. You know, you are going to have a hail claim. I had three, so I'm out of state right now. And I have several clients who purchased homeowners insurance with me May of last year. All 5 of those people in June had experienced a hailstorm. They didn't even pay a year's worth of insurance at that point. Granted, I mean, they did pay the insurance, but they didn't use a year's worth of insurance at that point. And they were getting $30,000 roofs. $10,000 roofs. I mean, it's not some little tiny cost when it's coming to roofs. And that's what's really killing us is the roof replacements and stuff. I mean, you look at these, you know, multi-million-dollar property values for condos, they all need roofs. And that's really where it comes into play. And especially in older buildings older wiring. Underwriters are really looking at all of these things in order to determine whether or not they're policy worthy. And if one company is not going to accept them, you bet your bottom dollar you're probably not going to find something better.
Wow.
What do you think the solution is? Because in one sense, insurance companies are demanding something that could hurt lending. In the other sense, the lenders are demanding something that requires the insurance companies to offer better coverage, but they're not going to do it.
Yeah, well, they can't. I mean, if they continually not raise rates and increase deductibles and things like this, there's only so much money in a reserve. Look at State Farm. They recently went from an AM Best rating to an F rating. They lost $18 billion last year. This year, I heard some report, and don't hold me to this, I've just heard it on in passing. $14 billion already with claims and stuff. I mean, it's just a never ending thing right now with all of these, extraordinary weather phenomenons. And not only that, people being freaking crazy. More now than ever, people are willing to, get out and shoot you on the side of the road. They're willing to, steal your possessions. Robberies are up. All of these things that really impact insurance and impact the way they're having to spend out this money. It's not just roofs. It's also liability claims. It's the number of autos that are on the road. It's people being reckless without regard anymore. And just the different kind of society almost that we're living in that really has been playing a pivotal role in these insurance premiums. But also, it definitely is wind and hail. So it is a perfect storm of things, and I don't know what will change it, but I have heard, of course, these market reps are, obviously trying to walk us off of an edge because we're all, absolutely freaking out. They say that in 2025, things will settle down, but it's hard to say. If we have another year like we've had the last 5 years, I don't know what will happen. I don't know how they can continue to pay out these huge amounts for catastrophic roofs, for all these auto accidents, all these things, and have money in a reserve. It just does not seem possible to me. But
So what makes them think that 2025 is going to be this better year?
I think because they've really done a lot of back end underwriting practices and they've increased rates to a certain point. Insurance carriers are looking for their ideal clients, and that's smart of them because, you don't want to get in with people who, have junk properties and, huge amounts of claims. You don't want to accept a client who, you don't want to just accept anybody. It's like, look at your friend circle. It's who you surround yourself with is what you're like. And that's how it is with insurance too. I've mentioned in the past on a lot of these presentations, insurance carriers are now doing aerial photography of properties prior to issuing a policy. And what they're looking for is junk cars on the property, neighboring properties with huge amounts of garbage and rubbish and things like that. John, me and you have a mutual client who has a situation like that on a mountain property. Their neighbor has huge amounts of garbage and rubbish. And if there were a fire to break out, that neighbor's junkyard impacts that other person. And so they're really looking at all of these things. And in addition to that, in the past, there have been a lot of agents who do untrustworthy practices. When I first started my agency, I had a client who went with another traveler's agent who was giving them a new roof discount. They didn't have a new roof. But because at that time, Travelers was not requiring documentation on that, he went with it. And I told him explicitly, if your agent says you have a new roof, you have a hail claim that requires you to get a new roof, they're going to look at your application and see that you didn't have a new roof. And you may not even get a payout on that because you've now falsified an insurance claim. And falsified an insurance application. You knew darn well going into that policy that there was no new roof. And so, it comes down to a lot of things. And that's why these carriers are doing so much more extensive backgrounds with the underwriting practices. When now these days, if you're saying you have a full plumbing renovation, you better have the documentation to support that. Because if you don't, A, you're not getting the higher policy, and B, if something happens, you don't have proof of that, you've lied on an insurance application. They are taking these things very seriously. A lot of insurance carriers right now are requesting that, like, for instance, Progressive Insurance, in order to get a home policy with some Progressive clients, you have to pay for an outside inspection, somebody to come into your home, a qualified inspector, take pictures, provide all of this documentation, note the roof, note the condition of the property, what type of plumbing they have, all of these things, just to get a quote. People aren't doing that. They'll go to another carrier who will take them, but that's ways that carriers are, avoiding new business.
Hmm.
And one thing that makes it hard, not to like take this over, but one thing that makes it hard is when one insurance carrier or then two insurance carriers limit their amount of new business, and then that third insurance carrier is getting completely bombarded with new business, then they have to take a step back too, because they only have so much in their reserves. So
Wow.
it's a whirlwind. It's crazy.
You just keep scaring me, Amber.
I'm scared to death, Jen.
I know. Oh,
I can't be a mortgage lender. We've already got you.
I know I've got this like gothic black presentation here. But we gotta look at reality. So, but we do have these loopholes here, and so we do want to make sure we reiterate those. That FHA approval, that is a loophole. If you end up coming across that deductible, look to see if they've got FHA approval. It might be something that saves you from having to go with a cash buyer. But again, know that that's a limited time. Also that there is, see if there's a buyback policy. Again, if you remember when we looked at that earlier, specifically, that was at the bottom there on the note. A buyback policy could also potentially save that deal.
Can you remind me what that is again?
I don't quite know. It's the first time I've ever heard of it. But I'm guessing that it's something that's kind of like just like a bridge, or maybe like an umbrella of some sort that would help bridge the gap in the 5%. If it's more than a 5% deductible, it was
Okay, so the HOA would actually buy it.
It was
So it's
something.
like-
Yes,
like
and
a-
the
like
HOA,
a
the
gap,
board.
almost like a gap policy.
Yes, I think so. I think that's what they were
Okay.
asking for. And then again, if you can find the unicorn out there of a master policy that is per unit, you can try to use that as an exception to get past that higher deductible. But it does have additional requirements on that. So, but since they're so rare, we're not going to go into all those. And that's my contact information, and you're welcome to shoot a picture with your phone and with that QR code. I am with Equity First Financial, and that is my contact info if you have any lending questions at all. And then otherwise, I'm gonna switch out of this presentation and go back to, bear with me here, our primary HHH presentation to see what is coming up in the future. And I'm gonna let Amber do this introduction on this one. Sorry, guys. Take it away, Amber.
Awesome. Well, Jen, thank you so much for sharing that information. It really is interesting the way the market is changing, the way all of these things are kind of being impacted. And, to have someone like you who can share what to look for, what to look out for, and how to kind of get around some of these things is really critical. So we really appreciate you sharing that with us. Next week, or sorry, our next Tuesday after next, the 9th at 7 p.m. I will be presenting. I hope you all join us. Insuring tomorrow, navigating personal insurance in a world of change. There will be a new RSVP link on a new Zoom link on the meetup. So do make sure you're keeping an eye on that. You can follow us and chat with us during the week on our Facebook group, linked there. And then we also have our YouTube channel at House Hunting Hacking. So please do make sure to check out our past videos. We've talked a lot about, lending, the realtor side, short-term rentals, insurance, all those things on those past recordings. So do make sure you're checking that out if you have the opportunity. We'd love to see you there. Subscribe, like, and share with your friends.
Wonderful. Thanks so much, guys. I guess I'll see you in a couple of weeks then at our next meeting. If I don't talk to you before then.
Perfect. Sounds great. Bye,
Bye.
guys.